Ever wonder how successful investors consistently pick winning stocks? It's not luck, it's all about understanding the numbers. In this video, we're breaking down the most powerful financial ratios that top investors use to uncover undervalued gems and avoid costly mistakes. Whether you're just starting out or looking to sharpen your investing skills, these insights will give you the edge you need to succeed in the stock market. Before we dive in, please remember that information provided in this video is for educational and informational purposes only and does not constitute financial advice. Let's start with one of the most popular ratios out there, the price to earnings ratio, or PE ratio. This ratio tells you how much investors are willing to pay for each dollar of a company's earnings. A higher PE ratio might suggest that the market expects high growth from the company in the future, but it could also mean the stock is overvalued. On the other hand, a lower PE ratio might indicate that the stock is undervalued, or it could be a sign of potential challenges the company is facing. Take Tesla for instance, which often trades at a high PE ratio, recently around 70, because investors expect significant growth. Compare that to Ford, which has a much lower PE ratio around 6. This lower ratio might signal that Ford is undervalued or that investors have concerns about its future growth. When evaluating stocks, compare the PE ratio to the industry average and the company's historical PE ratios to get a sense of whether it's fairly valued. Next up is the price-to-book ratio, or PB ratio, which compares a stock's market value to its book value. The book value represents the net asset value of a company according to its balance sheet. A PB ratio below 1 might suggest that the stock is undervalued, meaning it's trading for less than the value of its assets. However, a low PB ratio could also indicate underlying problems with the company. Conversely, a PB ratio above 1 indicates that investors are willing to pay more than the book value, often because they expect future growth. For example, JP Morgan Chase has a PB ratio around 1.5, suggesting investors are willing to pay a premium for its strong balance sheet and earnings potential. Citigroup, on the other hand, has a PB ratio closer to 0.6, which might indicate it's undervalued, but it could also reflect concerns about its financial health. This ratio is particularly useful for evaluating companies with significant tangible assets, like banks and manufacturing firms. Always compare the PB ratio to industry peers to identify potential undervalued or overvalued stocks. Moving on to return on equity, or ROE, which measures how effectively a company uses shareholders' equity to generate profits. This ratio is a great indicator of management's efficiency. A high ROE suggests that a company is good at turning equity investments into profits. It indicates efficient management and a strong business model. But beware. A very high ROE could also mean the company is taking on a lot of debt to boost returns. Take Apple, for instance, with an impressive ROE of around 30%, which indicates strong management and high profitability. Compare that to IBM, which has an ROE closer to 8%. While IBM is still profitable, it may not be as efficient in generating returns on equity as Apple. When analyzing ROE, compare it with industry averages and consider the company's long-term ROE trends to ensure it's consistently high. Finally, let's talk about the debt-to-equity ratio, or DE ratio, which measures the proportion of debt used to finance the company's assets relative to shareholders' equity. This ratio gives you insight into the company's financial leverage and risk. A high DE ratio indicates that a company is heavily reliant on debt, which can amplify returns during good times, but increase risk during downturns. A low DE ratio suggests that the company is less dependent on debt, which generally makes it safer, but might limit its growth potential. For example, Coca-Cola has a DE ratio of around 2.0. Meaning it uses $2 in debt for every $1 of equity. This higher leverage might enhance returns, but it also increases financial risk. In contrast, Microsoft has a DE ratio of about 0.5, indicating a more conservative use of debt, which may make it a safer bet in uncertain times. When evaluating a stock, compare its DE ratio to industry norms. Some industries, like utilities, typically operate with higher debt levels, while others, like tech, may have lower DE ratios. Now that we've covered each of these key ratios individually, Let's talk about how to combine them for even more powerful investment decisions. No single ratio tells the whole story, but when you combine them, you get a much clearer picture of a company's overall financial health and potential for growth. Here's how you can do it with a real-world example. Let's take Nike as an example. Nike has a PE ratio of around 32, which is higher than the industry average. This suggests that investors expect strong future growth. Its PB ratio is around 11, reflecting strong investor confidence in the company's asset value. Nike's ROE is impressive at around 35%, indicating that management is effectively generating returns on equity. Finally, its DE ratio is about 0.8, showing a balanced use of debt and equity. By combining these ratios, we see that Nike is a growth stock with strong profitability and moderate financial leverage, making it an attractive option for long-term investors. However, the higher PE ratio means you're paying a premium for that growth, so it's essential to consider whether the potential rewards justify the risk. When you analyze a stock, look for a combination of low PE and PB ratios with high ROE and a manageable DE ratio. This balanced approach helps you identify stocks that are not only undervalued, but also have strong profitability and manageable risk. There are a few more ratios you might want to consider. 1. Current ratio. The current ratio is a financial metric that measures a company's ability to pay off its short-term debts due within 1 year, with its short-term assets, cash, or assets that can be converted to cash within 1 year. In simpler terms, it's like checking if you have enough money in your wallet and readily available savings to cover your upcoming bills and expenses. 2. Quick ratio. The quick ratio, also known as the acid test ratio, is a financial metric that measures a company's ability to pay off its current liabilities, short-term debts, with its most liquid assets. In simpler terms, it's similar to the current ratio but is more conservative as it only considers assets that can be quickly converted to cash, typically within 90 days or less. 3. Earnings per share, EPS, is a financial metric that indicates the portion of a company's profit allocated to each outstanding share of common stock. In simpler terms, it represents how much profit a company has generated for each share of its stock. 4. Dividend yield. Dividend yield is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. It's expressed as a percentage. In simpler terms, think of it like the interest rate you earn on a savings account, but instead of interest, you get dividends for owning shares of a company's stock. And there you have it. These are essential financial ratios and a powerful strategy for combining them to make smarter investment decisions. By understanding and applying the PE ratio, PB ratio, ROE, and DE ratio together, you can better assess the value and risk of different stocks in the market. Remember, successful investing is about seeing the big picture. Use these ratios together, compare them within the context of the industry, and always consider the company's historical performance. This holistic approach will give you a significant edge in the stock market. The information provided in this video is for educational and informational purposes only, and does not constitute financial advice. Thank you for watching. If you enjoyed this content, please consider subscribing and leave your comments below. See you in the next video.